This is Ask Todd on the Financial Exchange Radio Network. If you have an existing estate plan or are in the market for one, Todd Lutzke is here to answer your questions and help you plan for later life. Ask Todd is presented by Cushing & Dolan, serving Massachusetts and New England for more than 35 years, helping families with estate and tax planning, Medicaid planning, and probate law. Visit CushingDolan.com. Now, here's Todd Lutzke.
As promised, we are now joined by Todd Lutzke from the law firm of Cushing and Dolan. We call the segment Ask Todd because we open up the phone lines and you get to ask Todd your questions about estate planning. The studio number here is 888-205-2263. So get calling if you want to ask Todd your question about your estate plan. We usually only have the opportunity to speak with 2 to 3 people at any given show, so again, that number is 888-205-2263. Get calling early to make sure you get queued up and get one of those spots. That phone number again is 888-205-2263. Mr. Lutzke, how are you today?
I'm never better, and you?
Good. I'm in the middle of an experiment right now.
You're experimenting?
I ordered a chicken and an egg from Amazon.
Yeah?
I'll let you know.
Yeah.
I'll let you know.
Well, let me know. Okay.
Todd, I want to talk a little bit about revocable trusts. I have a question for you on them. And specifically, it relates to the taxation of revocable trusts. Let's say that someone goes and does trust planning and chooses to utilize revocable trusts. How does that impact their tax situation on a yearly basis?
And there are many differences between these trusts, and there's many similarities. But let's talk. This one is just about the revocable, correct? So on the revocable trust, do we have an income tax, I believe is the question, an income tax difference?
Yes.
So when you put assets in these trusts, that could be owning something like, just so you understand why this is even a question, you're going to be funding this trust with something like an investment portfolio, bank accounts, maybe a rental property. And so those assets that are now owned by the trust are generating income, interest, dividends, capital gains, or rent. Well, that income needs to be income taxed to somebody. Well, if it's owned by the trust, the question is who's paying the tax? So when you title assets to a revocable trust, those investment or bank accounts will have a tax ID number equal to your Social Security number. So now that you know it's in your Social Security number, you can ignore filing any income tax returns for the trust and just keep on filing your own income tax returns, that being your 1040. And so, long-winded answer to say, there is no change from an income tax perspective when you have a revocable trust.
What if you are utilizing an irrevocable trust designed to protect assets from a nursing home? How does that impact the income tax situation?
And that is critical because there's many kinds of irrevocable trusts, which is what Chuck's alluding to, right? So you got to check the kind of irrevocable trust you have. And for income tax purposes, it matters whether that trust is a grantor irrevocable trust. What that means in English is that you, the creator, are still the owner for income tax purposes. So when you set up an irrevocable, we'll use Medicaid trust, as you mentioned, Chuck, and you put in those brokerage accounts or that rental property, the brokerage account now will have an ID number given to it because the trust will have its own ID number. So once the trust gets its own ID number, the IRS will be looking for a tax return for that ID number. However, if it's a grantor trust and this trust earns interest, dividends, and gains, whether it's distributed out or not, because it's a grantor trust and you're treated as the owner for income tax purposes, it will get picked up on your own personal 1040. So in English, yes, there's a little difference. You have to file an extra return for the trust. It's called a trust return, but it pays zero tax and everything flows through to your personal return.
Talking with Todd Lutzke from the law firm of Cushing and Dolan. We call the segment Ask Todd because it's your chance to ask Todd your questions. Still have room for another person or two on the phone lines. That number is 888-205-2263. That's the number to call to ask Todd a question live on air. We're going to take a quick break, but when we come back, it's right to your phone calls. That studio number again is 888-205-2263. Quick break. Right to your phone calls when we return.
Ask Todd with Todd Lutzke every Wednesday at 10:30. Only here on the Financial Exchange Radio Network. You're listening to Ask Todd with Todd Lutzke on the Financial Exchange Radio Network.
All right, it's time to get right to your calls with Todd Lutzke. First up, we've got Tom on the Cape. Tom, what's your question for Todd?
Good morning, gentlemen. How are you?
Great.
It's in regards to my aging mother who's now in assisted living. She had gifted us the maximum, or whatever, I think it's $18,000 or $18,500, whatever it is, the state of Massachusetts. Does that look back pertain to a gift also, or is it strictly just for her assets?
Yeah, so a great question. It's confusing for folks. This is when you're thinking about protecting assets from a nursing home, right? First of all, assisted living is going to be private pay. She would need to, decline and need further help to be in a nursing home in order to get eligible for Medicaid. But a look back is a 5-year look back for, and I'll just give you the definition. Anytime a person takes any asset and that was formerly available to the nursing home and puts it somewhere where it's no longer available, you create a 5-year waiting period. Forget the amount for the moment. So this $18,000 number you're discussing is confusing for people because for gift tax purposes, you're right. It's a freebie. You don't need to file a 709 gift tax return, and you don't need to pay any gift tax, and you don't need to report it anywhere. It's $18,000 per year per person. That's for IRS gift tax purposes. For Medicaid eligibility purposes, completely different rules. Every penny you give away creates this 5-year waiting period. So that 18 is still going to create a 5-year waiting period for each person that they gave it to. So hope that helps a little. But, these are the kind of things that are confusing to people, and maybe the better approach for Tom's mother at this point. Again, she's still in assisted living and maybe has an opportunity to do some planning. Figure out whether a revocable or irrevocable trust is right for you. That's what this guide does. It's new for the month. It helps you if you haven't done your planning. Learn what the differences are between the two. And if you have done your planning, maybe you want to switch. But here, more importantly, it talks not only about the income tax gift differences, which is what Chuck asked me about earlier, but are there gift tax differences? What about the estate taxes? Do they do the same thing? And more importantly than all that, how does it work day to day? What can I do with assets in there? What can I not do anymore with assets in there? It really will clear up one of the most frequently asked questions there is. Call and get the guide, differences between revocable and irrevocable trusts, 866-848-5699 or legalexchangeshow.com. One more time, 866-848-5699 or legalexchangeshow.com.
Todd, I got another one here for you. We've got Lori in New Hampshire. Lori, you are on with Todd Lutzke.
All right. Thank you. Hi, Todd.
Hi.
I just have a question. My husband and I are in our young 50s, 52, 53. Mm-hmm. We have a lot of money set aside for retirement, probably close to $1 million. Mm-hmm. We have a lot in our checking and savings account. Mm-hmm. I don't know if we should put everything in a trust. We have property, probably 27 acres.
Sounds nice.
I don't know if this is something that we should look at to put in a trust.
Do you have kids?
Yes, we have 3 kids, and we do have a will, and it's set up that it'll be whatever happens to us. Are
the kids minors?
20 22, 19, and 15.
So one minor, so that's important. So
Yep.
just listening to what you're saying, you have the will, which is basically not an overall estate plan. Some people think it is, but it's really not. And so for someone in your case, yeah, mid-50s, early 50s, you're looking like you say you got $1 million in retirement. You probably have who knows how much more in bank accounts. You got 27 acres, a house. You know, you start adding up all that stuff, life insurance, you're probably well north of $2 million in total value of your estate. Would that be fair to say?
I think so, yes.
Yeah. And so you need to start thinking about estate taxes, one, because you've now exceeded your estate tax exemption threshold in Massachusetts. So that's $2 million. But by doing basic trust planning, we can eliminate that up to $4 million. We can double that. So if you're under $4 million with a basic trust, we can eliminate taxes, number one. Number two, we can avoid probate so your children don't have to go through all that nightmare. We keep you in charge of everything because I think a revocable trust is probably in order for someone in your situation, your age group. I mean, I don't think we're worried about nursing homes quite yet. And the other big thing to think about is you still have a minor child who can't own anything. So if you happen to die before that child reaches majority, you know, they can't own real estate, they can't own investments. So you want to put it in a trust for them. And so this, and even your other kids, you know, with your size of your estate, you might not want to just leave things outright to them yet. You might want to control it for how they get it and when they get it through a trust. So I think you are in absolute right order to do a plan of some kind, probably a revocable trust plan, a joint revocable trust will work. And you know what? That's exactly what this guide's about, folks. It's about revocable versus irrevocable to help you decide which way is right for you. So hopefully that helped you out.
Todd, I've got one more for you here. We got a couple minutes left. Let's go to Mark in Falmouth. Mark, what's your question for Todd?
Hello, Todd.
Yes.
Hi. Todd, I've got two properties, both of them in an irrevocable trust. Both of them have passed the 5-year look-back period.
Okay.
Getting ready to retire. We want to sell the primary residence and tear down the second cottage and rebuild it. So my question is we have money outside the trust that I'm going to put into the cottage to rebuild it. Will that, putting that new money in to rebuild the cottage, will that start my 5-year look-back on that by introducing those funds?
So the quick answer is yes. If you take money that's not in an irrevocable trust now and put it in an irrevocable trust, you will create a new 5-year waiting period, but only for the new money. Okay, so it's not going to start a new 5-year waiting period for the two properties that are already in there. Now, what I might suggest, and again, so that's really good news at the end of the day if there's no other money in the trust. What I might suggest, and what I heard you say is, I might be selling the primary residence that's in there. And if you sell it, the trust can in fact sell it. It should provide no adverse income tax consequences to you, meaning you'll still get your capital gains exclusion. But more importantly, you'll now have money in the trust, and the selling it is not going to start a new 5-year waiting period on that asset. So now you have money in the trust. Maybe use that money to fix up the property that you were talking about putting money in the trust to use to fix up. If you can swing it that way and do it that way, then you don't reset the clock at all. That said, if you have extra money outside the trust that you would like to protect anyway and you're not really old yet, then maybe you put more money in and get your 5-year clock started. So now you've protected the two properties and even some extra money along the way. But those are the kind of things that you need to think about when you have it. But I hope everybody listening heard how flexible an irrevocable trust can be just from this question.
Mr. Lutsky, thank you so much for joining us today.
Always a pleasure. Thank you.
This has been Ask Todd on the Financial Exchange Radio Network. Ask Todd with Todd Lutsky has been presented by Cushing & Dolan, serving Massachusetts and New England for more than 30 years, helping families with estate and tax planning, Medicaid planning, and probate law. Call 800-393-4001 or visit CushingDolan.com. The views expressed in this segment are solely those of Cushing & Dolan. Armstrong Advisory does not provide any legal or tax advice. Please consult with your legal or tax advisor on such matters. Cushing & Armstrong do not endorse each other and are not affiliated. Revocable and irrevocable trusts are commonly used to protect your assets, but there are significant differences between the two. Don't take chances securing your future. Call Cushing & Dolan right now at 866-848-5699 and get their brand new guide called The Differences Between Revocable and Irrevocable Trusts. Cushing & Dolan are experts in elder life planning, and they can answer critical questions that you may have as you determine which trust may be best for you and your family. The guide contains crucial information about a variety of topics, including the income tax effects of both trusts, ways to leave assets to your children, as well as many other factors you should consider in the estate planning process, such as your net worth, your age, and your marital status. Call today, 866-848-5699. That's 866-848-5699. Or request the guide online from their website, LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Armstrong do not endorse each other and are not affiliated.